Hello everyone, Justin with Deep Dive Stocks here, and today we're going to be doing a weekly review where we look at the data for the week of March 6th to March 10th through the lens of Deep Dive Stocks. We're going to look at what Deep Dive Stocks expectations were for the week of March 6th to March 10th, and how those expectations were managed and how they changed throughout the week during what was a pretty fun week, right? Like a surprise ending to the week. And so what better week to do a weekly review where we can look at how the data helped navigate these pretty turbulent and exciting markets and what that might mean for the future. So without further ado, we started the week with a few expectations, and these expectations were discussed in the weekly chat that went out on March 5th, the Sunday before the week of March 6th. And one of the main ideas in the weekly chat was that the market was slowly regaining stability. And we had established several reasons or several main data streams that we were keeping an eye out for in order to maintain this expectation. And it's important to note that this expectation shaped the overall view of Deep Dive Stocks expectations for both the week and longer timeframes. One of the main pillars or main foundational arguments for the idea of returning stability was VoEx on SPY. We noted that it was presiding longer and longer inside of stability. Even last week, when it dipped into the propagation zone, we set a line in the sand that said, as long as VoEx re-enters stability by Friday, we can maintain our outlook that the market is regaining stability. And by Friday, that was exactly what happened. VoEx moved back into the stable zone, and so the idea that returning stability throughout the market was still valid. And so the week ahead was framed by this idea that stability was returning, and in fact, we should expect some appreciation because VoEx had, as we demanded of it, re-entered stability. However, there were some concerns that the earlier part of the week might experience some more turbulence than expected. And this came from two main data points. The first was that SPY did move about twice its expected price range on Friday alone. This is pretty concerning, and it always gives a threat of mean reversion. Along with this mean reversion, QQQ's hedging environment was almost catastrophically bad. We note that there was intense selling pressure located spot down and IV up, and so there was a mixing of elements such that the casual mean reversion that we expect to occur on SPY might spill over into QQQ, promoting selling pressure, which would work to bring the market down as a whole. But this near-term stability did look like it would just be near-term. And there were two main arguments for this idea. The first was that SPY did have some pretty good purchasing support located spot down, so that if QQQ's selling pressure did kind of engage as QQQ or the technology sector started to fall, SPY's purchasing support would kind of come in and help bring the market back up. And the second argument was, the idea that this stability was returning to the market. VoEx had moved back into stability the Friday prior, and it was overall matching our expectations of a VoEx that was indicating stability. Another factor in the idea that the turbulence would be near term and there would be some longer term appreciation and stability was the dealer long put behavior. Traditionally, QQQ sees a surge of dealer long puts just before a nice price appreciation. We can always thank the put sellers for being oddly well timed, and this was exactly what was occurring on QQQ and what had just started to reoccur. So it looked like this new behavior, but behavior that we are familiar with, started ramping up on QQQ, indicating that those who were selling puts did also have they do tend to have a knack for knowing when the market was going to go up. So those were our expectations for the week ahead. So overall, the expectation for the week was most likely a red Monday and Tuesday and a appreciating latter half of the week for an overall net green finish. That didn't really happen, right? So let's check out why that didn't happen, how it evolved, and if Deep Dive Stocks data helped us navigate throughout the markets during, again, this pretty remarkable week. SPY moved a net of 0.07%, but we see that it really dropped throughout the trading day and gave up almost all of its pre-market moves. and had a net movement of 0.11% on Monday as well. With these moves, SPY's VoEx stayed inside of stability, which was a promising event, and so did QQQ's. Additionally, the new hedging environment on SPY showed a persistence in the purchasing support located spot down, volatility up, and QQQ's heat map was clearing up a little bit. We didn't really have much purchasing support, spot down, volatility up, but at least there wasn't an obscene amount of selling pressure like there was entering into the week. But some of that turbulence that was expected did start to show up. One of the ways that it did was that we did see an increase in the number of market-wide gamma squeezes. This, of course, has bearish connotations, but we did note that the overall trend or behavior of the market-wide gamma squeezes was pointed negative. So a slight increase, but it did look like the overall trend was still a decrease in the number of gamma squeezes. So as Monday ended, the outlook for the week did stand. Early week turbulence, longer term stability, and end of week appreciation. So let's check out Tuesday. Tuesday is the day that tested the idea or tested the limits of what a reasonable amount of turbulence in the market was. Tuesday saw some significant moves with SPY losing about 1.5% and QQQ losing 1.2%. Those are some pretty big moves, and they were both almost double the expected price range for those individual indices. Additionally, along with these drastic price movements, VoEx fell into the propagation zone. This was a huge red flag. Again, remember, we had this foundational idea that stability was returning to the market precisely because VoEx rose out of the propagation zone in the time frame that we gave it. And the idea was that VoEx would stay inside of stability because that is what we were expecting, and that's what one would expect in a stabilizing market. So with such a quick reversal back into the propagation zone, this was definitely a red flag that perhaps the turbulence that occurred on Tuesday alone was sufficiently large to disrail the outlook for the rest of the week. In addition to that, throughout the market, we saw that the market-wide gamma squeeze count skyrocketed. This is a pretty heavily bearish sign, and it really left deep dive stocks at the end of Tuesday concerned that the Tuesday's instability or Tuesday's turbulence alone was quite sufficient to derail the outlook for the rest of the week. So Wednesday came around, and Wednesday really was the deal breaker. If Wednesday did start to stabilize a little bit, then the outlook could tenuously be maintained. But if Wednesday did see a continuation of this instability, then it was time to pivot and look for alternative outlooks for the rest of the week. So Wednesday came, and it was relatively remarkably unremarkable. A flat day for both SPY and QQQ and the market at large. And we saw that with SPY's hedging environment, it looked like that purchasing support did kick in and was just enough to stop a downside from forming and kind of snowballing into something bigger. With that, we saw that market-wide, the put sellers were still quite active. They were happily taking the risk of a spot down IV up, which is the greatest risk for those who are selling puts, and they were doing it with some pretty strong vigor with some day-over-day percent changes of nearly 100%. Additionally, the market-wide gamma squeeze count did see a decrease in the number of gamma squeezes. And this is what we would expect in a market that is cooling off and starting to appreciate. We would expect those who are taking risks to begin taking risks with greater degree of zeal. We would expect the number of market-wide gamma squeeze counts to decrease. But we did still have those massive red flags that VoEx was now back in the propagation zone, which is a pretty strong indicator for near-term downside. And so the data was definitely more mixed than deep dive stocks would probably have liked, and definitely more than what was expected. The ideal situation would have been if the DLPs continued to be opened and the market-wide gamma squeeze count did drop and VoEx moved back into stability on such a mediocre day. But that didn't happen. And so while the outlook for a rest of the week being green was still technically alive, it seemed like the probability of that occurring did diminish. And Thursday was very quick to show us that this diminishing probability was in fact going to be fulfilled. Thursday saw SPY drop by 1.84% and QQQ dropped by 1.73%. And there were two main things to note with this drastic price movement. The first is that this was double SPY's expected price movement for the day, so that is double the amount that the market thought that SPY would move throughout the next day. And this movement occurred in spite of some pretty hefty and significant purchasing support on SPY. With that, SPY's net delta dropped by a staggering 103%, and because of these movements in both spot and volatility, SPY incurred a 90 million share hedging requirement on Thursday alone, which means that the amount of hedging that had to be performed because of the price and volatility movement was a staggering 90 million shares had to be sold. That's pretty significant. In addition, the dealer long put behavior did a sudden 180 degrees. All of a sudden, QQQ and SPY put sellers were no longer comfortable selling puts on the indices. And this is traditionally associated with near-term significant downside. Again, like I said, the put sellers tend to be relatively well timed. And so seeing such a quick pivot from a massive amount of dealer long put opening to almost a complete halt and reversal of those dealer long puts is a pretty significant indicator that not only do they think that this movement was severe, but they also think that the movement in the future is going to be severe or at least non-conducive to selling puts. And so that would be like a spot down, volatility up. And if we look at SPY's heat map from the Friday prior, we see that we had that leveling off of the indice as that purchasing support kicked in, and then that purchasing support ceased to matter as the indice and the market at large plummeted. This week was so special because, again, we had this very tenuous stability forming, and then on Thursday, all of the news broke about both Silvergate and Silicon Valley Bank. So clearly the exact thing that we did not want to happen, which was a cataclysmic event or something that would push the market into a sell-off, had occurred. And this was something that we talked about for quite a while in the weekly chat, that this very tenuous stability that was forming really couldn't be disrupted too greatly. And we were always on the lookout during red weeks to ensure that that week didn't disrupt the foundations of this budding stability. It seems like maybe Thursday it did. When Thursday started, the market quickly pivoted red, and LDPM indicated poor liquidity on the upside, and that downside was the most likely outcome. And that is exactly what occurred throughout the entire day. And again, this downside occurred despite a potential for mean reversion because of SPY's movements, and it chewed through all of the purchasing support located in the hedging environment on the S&P 500. So these downside movements were pretty significant and very aggressive. And at the end of the day, we saw a substantial increase in the number of gamma squeezes throughout the entire market. So again, it looked like Thursday was the nail in the coffin, and that the idea of this returning stability, although I still don't think it was wrong, the data did point very nicely to that, but the market was in a position that it couldn't absorb a bank run. I don't think that was reasonable in both the market at large and just with the current financial situations on a macro level. And so even those protective measures that were forming throughout the market that would help mitigate some minor or moderate turbulence, we see in the data was very quickly engulfed and just swallowed up by this two banks failing almost back to back. So not only did the rest of the week have a red tinge, there is this idea the data has to be re-examined to see just how deep this contagion goes and what it means for the market at large, especially if it means that the foundations of the budding stability that we've been kind of monitoring very closely for the past 3 or 4 months may have just been evaporated from existence. And so on Friday, we weren't too surprised with the price action. SPY fell 1.41% and QQQ fell 1.4% as well. And this really exemplifies how dynamic this current market is and how important it can be to keep track of both intraday metrics like LDPM and more macro end-of-day metrics like VoEx and especially the market-wide gamma squeeze counts, and in particular the hedging environments. It can always be frustrating when the hedging heat maps don't seem to be listened to, or when a price moves very significantly through purchasing support like we saw with SPY and a little bit on QQQ. Those days and those movements are in and of themselves very important because it shows you just how aggressive and how robust the selling pressure throughout the market was. This purchasing and hedging that was required by the options dealers was performed, but it was quickly engulfed and swallowed up by those selling shares, and they sold shares at such an aggressive pace and in such an aggressive stance that it continued to drop the market nonetheless. And so a very exciting week indeed, although it did and still is testing the overall idea of returning stability to the market, and that is something that will be investigated further in this week's weekly chat. In a nutshell, we started out the week with a overall outlook for returning stability throughout the market, but we did expect some near-term turbulence because of the hedging environments and the expected price ranges. This near-term turbulence did manifest, and we saw on Wednesday the market did start to level out a little bit. And this was evidenced by the hedging environments, deal-along put behavior, and the market-wide gamma squeeze counts on Wednesday. However, certain signs were present that this stabilizing Wednesday may not lead to a green rest of the week, namely VoEx moving back into the propagation zone. This was something that was not expected. And then on Thursday, where we expected some green throughout the day, maybe a casual drift up and leading us into the rest of the week, LDPM quickly indicated that red was the name of the day, and this was a huge nail in the coffin for the idea that the rest of the week would be green. And the data prints that resulted by the end of the day on Thursday only confirmed this suspicion, with the drastic increase in the number of market-wide gamma squeeze counts and the sudden change in behavior in those that were selling puts on SPY and QQQ. This left a red or bearish outlook for the rest of the week, and indeed on Friday that is exactly what we experienced. But again, this week was interesting in and of itself, but this week was also pivotal because it was such an important week for the overall thesis that the market was regaining stability, and because almost all of the evidence for that, or the main lines of data, namely VoEx, the options positioning, the hedging environments, were demonstrated this week to be insufficient to absorb such a large blow to the financial system by way of the Silvergate and Silicon Valley Bank developments. So now, not only did we have to change our expectations for the end of the week by Wednesday or Thursday morning, we now also have to re-examine if this returning or budding stability throughout the market is still a reasonable expectation. And that is something that we're going to be getting into in this week's weekly chat. But overall, I think this week was incredibly exciting. I love watching the data unfold in such a rapid manner. And even though there were times when your initial expectations of the market may not play out, we did have very clearly defined behavior that we were looking for the expectation of a green week. And when those behaviors weren't met by Wednesday and Thursday morning, we abandoned the expectations of a green week and quickly pivoted to a bearish week throughout. And I'm definitely looking forward to the next few weeks to really see how the market reacts and tries to absorb this blow from the financial sector, especially when just in 2 days, it seems like, again, all of the things that were kind of forming to build stability throughout the market were just completely wiped away. I mean, this is a pretty substantial event when a bank goes under, especially when the bank was central to the almost entire crypto space. So this has a lot of potential to be a very fascinating week in the weeks ahead. And yeah, so but I'll cut the video off here. The rest of the discussion on the week and weeks ahead will be in the weekly chat, but keep an eye out for it there. So that's all I have for you guys today. Thanks for coming and happy trading, guys. Be safe out there. Bye.